Many people having misconceptions in their mind. By assuming many things they are having are assets, but in reality it's not. They are literally fooling themselves. In this video, we will clear misconception and tell you these are not assets which you are thinking. For building wealth and achieving financial freedom. Stay with me till the end. Let's get started. Number 1. A family shelter or burden. Homeownership is maybe a dream of you and the most significant asset for your family. There is an undeniable emotional attachment to owning a home. Socially, it represents success and stability. However, in the financial world, a primary resident often functions more as a liability than an asset. The ongoing costs associated with homeownership are substantial. Monthly mortgage payments, property taxes, homeowners insurance, and maintenance contribute to a constant cash outflow. While homes can appreciate over time, this appreciation isn't guaranteed and often barely outpaces inflation in many markets. Moreover, any gains are typically not realized until the home is sold. Until you generate income from your home, it cannot be considered as asset. So, remove your primary home from your imaginary assets list. Number 2. Depreciating asset, the true cost of car ownership. Luxury vehicles often serve as status symbols, sign of success. However, from a financial perspective, cars are almost always liabilities rather than assets. I'll prove this. When you drive a new car off the lot, it depreciates, often losing 20 to 30% of its value in the first year alone. The costs associated with car ownership extend far beyond the sticker price. Insurance, fuel, regular maintenance, parking fees, and potential repair costs are significant ongoing expenses. Let's say you bought a car for $30,000. Over 5 years, here's what it might look like. Depreciation, $18,000 which lost in value. Insurance, $7,500. Maintenance and repairs, $6,000. Fuel, $7,200. Total costs, over 5 years, $38,700 for a $30,000 original price. While a car is essential and offers freedom and convenience, it's more of a financial burden than an asset. An asset typically appreciates in value or generates income. I cannot see neither of which applies to most of the cars. Number 3. Saving account. As of 2024, the average interest rate for a standard savings account in the U.S. is around 0.40% per year. Some high-yield savings accounts might offer rates around 4%, but that's still relatively modest. Over the past few years, inflation in the U.S. has averaged around 3% per year. This means that if your savings are earning 0.40% interest while inflation is 3%, the real value of your money is shrinking by 2.6% annually. While savings accounts are safe and provide liquidity, they're not the best vehicle for long-term wealth growth. Number 4. Employer benefits. If you frequently switch jobs, you might lose certain benefits like a pension plan or health insurance. Even if you stay with the same employer, benefits can be reduced or eliminated if the company changes its policies or faces financial difficulties. Employer-provided benefits are valuable and can significantly enhance your financial well-being. However, they're not liquid assets you can count on like cash or investments. They're also subject to change based on your employment status. It's wise to supplement these benefits with personal savings, investments, and retirement accounts that you control. This way, you're not solely dependent on your employer for your financial security. Number 5. Consumer goods. Imagine you buy the latest smartphone for $1,000. A year later, a new model comes out, and suddenly your phone is worth only $500 if you try to sell it. That's a 50% drop in value in just 1 year. Your fancy TV, laptop, or gaming console might provide entertainment, but they don't generate income. While it makes your home more comfortable, furniture doesn't bring in money. In fact, the more you use it, the less valuable it becomes. While high-end electronics and furniture can enhance your lifestyle and bring joy, they're not true financial assets. Number 6. Credit cards and loans. If you are thinking you are having the limit in credit card which you can use anytime and pretending it's asset, then you are so wrong. Imagine you take out a $20,000 loan to buy a car with an interest rate of 5% over 5 years. By the time you've paid off the loan, you'll have paid around $2,645 in interest, bringing your total cost to $22,645. Meanwhile, the car's value has likely depreciated significantly, as we discussed earlier. Number 7. Timeshares, vacation ownership or lifetime commitment. Timeshares are often marketed as affordable ways to secure future vacations, and potentially as investments in the hospitality real estate market. One of the most significant drawbacks of timeshares is their lack of flexibility. You're often locked into vacationing at the same time each year. Perhaps the most significant financial downside of timeshares is their poor resale value. Most times, shares depreciate quickly, and the secondary market is flooded with owners trying to offload their properties. Many times, share owners find it difficult to sell their shares even at a fraction of their purchase price. Number 8. Higher education, investment in the future or debt sentence. Higher education costs have outpaced inflation for decades, leading to a student debt. A college degree can certainly open doors and increase earning potential. It's crucial to consider any educational program's return on investment. Not all degrees or institutions offer the same value, and some may leave graduates with debt that far outweighs any increase in earning potential. This doesn't mean that higher education isn't valuable, but it should be approached strategically. Explore scholarship and grant opportunities vigorously. For those already in the workforce, employer-sponsored education programs can be a great way to advance your education without incurring personal debt. Also, alternatives to traditional 4-year degrees should be considered. Trade schools and vocational programs often offer excellent ROI, with lower costs and shorter time to enter the workforce. Online learning platforms and coding boot camps can provide valuable skills at a fraction of the price of a traditional degree. Understanding the difference between assets and liabilities is key to financial health. I hope till now you're able to identify which are the assets for you and which are not. As we bid farewell to these discussions, let us carry all the lessons learned and the wisdom gained into our own financial journeys. Like and subscribe to us for more financial knowledge. The more you know, the better decisions you'll make. From the bottom of our hearts, thank you for joining us today. See you in the next video. Until then, take care.